Good Monday morning. I hope everyone had a great weekend. Welcome back to Capital Markets Quickie. I'm your host, Endrit Cela. Last Friday, I promised we would talk more about the meeting of the central bankers in Jackson Hole, Wyoming, and give you my key takeaways. So, making good on that promise, let's get right to it. But here's a fair warning. It wasn't anything super exciting. But you should still listen till the very end. Okay, that was a bad strategy on my part. So, what went down at Jackson Hole? Did Jerome Powell deliver in his eagerly awaited Friday speech? Well, here are my thoughts. First of all, his speech was somewhat repetitive. He echoed sentiments he's expressed over the past few months on a regular basis, and essentially, once again, he's retaining maximum policy optionality. So what that means is that he will act accordingly depending on how the job market develops and ultimately on whether the Fed can get and keep inflation under control. Secondly, he made sure that everyone who thinks the Fed will adjust their 2% inflation target can keep on dreaming. However, some experts, and myself included, believe the Fed might need to consider a higher inflation target, perhaps something around 3%. Now, this could allow and would allow the Fed more leeway in adjusting its interest rate policy. And lastly, to wrap up his remarks, Powell ended on a poetic note, suggesting the Fed will follow the stars in a cloudy sky. Ugh, beautiful. But let me remind you, Mr. Powell, that sailing isn't just about navigation. More importantly, it's about staying afloat. Now, if the Fed continues to hike rates or keep them at this level for too long, they actually might trigger a recession. Okay, let me backtrack. The recession part has been priced in. However, the Fed could trigger a hard landing if rates remain higher for too long. Now, I don't mean to sound like a critic because so far the Fed has done a pretty good job, but, we could always backtrack and go a few steps backwards. So, how did the markets react to all of this? Well, it seems like the stock market is still on a break. I mean, it is August after all. And even though the S&P 500 and NASDAQ managed to break their 3-week losing streaks, the recovery was minimal. The S&P 500 closed the week up by 82 basis points, and the NASDAQ was up nearly 1.5%. Out here in Germany, guys, the DAX also managed to break its 3-week losing streak, closing the week up by 37 basis points. It's not much, but we'll take it. However, in terms of August performance, the DAX is down nearly 5%, the S&P 500 is down nearly 4%, and the NASDAQ is down 5.17%. Now, historically speaking, August is known to be a weaker month due to the lack of liquidity on the markets and everyone being on vacation, basically. However, September doesn't have a better reputation, so let's wait and see. Now, on the 10-year U.S. Treasury front, we actually did not see a lot of movement on Thursday and Friday as Jackson Hole was taking place. The 10-year yields closed the week at 4.25%, down from 4.26% last week. All right, everyone, that's it for today's Capital Markets Quickie. Thanks for tuning in. And I've noticed a surge in followers, so thank you guys for joining the community. Till tomorrow, cheerio.